Welcome back to Money with Jacob, coming to you every Tuesday and Thursday at 5 p.m. Eastern Time. And this is where you send me your money questions and I will answer them as if they were my own. And look, this is not financial advice. I am not a financial advisor. In fact, I have no financial license of any kind at all. All I have is a simple philosophy which has got me to where I am today. 28 years old, $750,000 in stock portfolio, and 100% debt free. So if you have any money questions, be sure to email them to me at jacobbuildswealth@gmail.com or leave them in the comments section below. I might get to those ones too. And let's kick it off. So today we have two questions for us to answer. And I'm going to start off with question number one coming from Shiva. Shiva writes, I'm 27 and living in North Carolina. I bring home about $70,000 a year after taxes. I'm single with no kids and I have about $4,000 left on my student loans. I haven't started saving or investing yet, but once that debt's gone, I really want to start building wealth. My goal is to hit $1 million by the time I'm 40. How much should I be saving and investing each month to actually make that happen? Shiva, you got an aggressive goal, girl. You got 13 years to bring in $1 million, not just make $1 million, but to actually save and invest $1 million on a $70,000 salary. So the answer to your question is you will need to be saving about 60% of your income to make this happen. And let's go through this together. So right now on my blue chalkboard, I love this blue chalkboard of mine, we are at 27 years old, $0. Over the next 13 years, you will be 40 years old and you want $1 million. And where we're at today, we got this $70,000 income and that is $5,833 a month. If you save 60% of your salary, that would be $42,000 a year or $3,500 a month. That only gives you $28,000 a year to live on, $2,333 a month. And we're going to come back to this because I think that's going to be super tough. Could you do it in North Carolina? Maybe, but we'll get back to this. So if we invest this $42,000 a year, this $3,500 a month into an S&P 500 ETF like Vanguard's VOO, averaging 10% a year, then we can see on a compound interest kind of payout scale here, it shows our total contributions, what they'll be over the next 13 years, and how we're going to arrive to this $1 million. And so the first year you would put in $42,000, then second year $84,000, third year $126,000. By the end of 13 years, coming all the way down to the bottom bar here, you would have invested $546,000, 60% of your income over the next 13 years. With the 10% on the interest in the stock market, that would give you a net worth of about $1,029,000. So you need to be saving about 60% or exactly 60% of your income if you want to be getting to $1 million by the time you're 40. Now, going back to living on $28,000 a year, I just want to be realistic, and I'm all for delayed gratification. I'm all for saving and investing and just being happy and content with the simple things in life. Give me the cheapest bread, the cheapest cheese, and the cheapest wine, and I'm as happy as a pig in mud. But living on only $28,000 a year in North Carolina, I feel like you're not even going to be able to afford that after we take out of our expenses like rent and utilities and stuff like that. It's going to be super tough. So I think we really need to be more realistic about our being 40 years old, making $1 million or having $1 million. And you got three options. One is I really think you're going to need to either make more money, two, get married, bringing in two incomes, it's going to be a lot easier. If you can find somebody else out there making $50,000, $60,000, $70,000 and all of a sudden you bump your income up from $70,000 to $140,000, you're going to get to that $1 million no problem saving 60% a year on your income. Number three is just kind of decreasing your expectations. I personally have saved 60% of my income. My wife and I have, but we were never, ever making less than $120,000 a year in combined income. So obviously the more money you make, the easier it is to save. And on $70,000 a year, trying to save 60% of your income sounds really tough. So if I were you, I really think that I would try to be aiming for 40%. That just feels a lot more realistic. You're going to be living on, let's say, $42,000 a year and then saving about $28,000 a year or $30,000. Flip your saving and living on goals the other way, and I think you're just going to build more wealth and enjoy your life a lot more. 13 hard years of making $28,000 or living on $28,000 $2,300 a month. That sounds like agony. Again, I'm all for saving and investing, but I don't think it's worth it. I don't think that there's any reason just to get to $1 million with the time you're 40 years old, put yourself through that pain. Let's just bump down that saving goal just a little bit until maybe you start earning more money. If you start making $80,000, $90,000 a year, I think maybe 60% could be more realistic, but let's just tune down those expectations a little bit. You're still going to be rich by the time you're old. You're going to be able to retire. You're still going to be pretty good, Shiva. All right, moving on to question number 2 coming from Nick. Nick says, I'm 32 and I consider myself a long-term buy and hold investor. I started investing in 2023 and have been putting everything into the Vanguard Total Stock Market Index, VTSAX. So far, the market's up about 70% since I started, and my portfolio's grown to around $80,000, which is basically all my life savings. I know the data says buy and hold works over the long run, but honestly, it just feels dumb not to take profits right now and wait for a pullback. It seems like easy money. What do you think? Nick, I'm inclined to agree with you. I do think the market has had an incredible run over the past 2 years. We are up over 70% right now. And I want to pull up some data. So this chart comes from Bloomberg. And Bloomberg shows where the market is at in terms of overall valuation versus what the earnings are in the total stock market. And right now, there's a yellow line, kind of like this yellow band, and a gray line in the middle of it. And every time we get to the top of this yellow band, this kind of channel here, the market sells off. And that's because whenever the valuation of the market is much higher than the stock market earnings, that means the stock market's expensive and we should expect less in future returns. And we can see this going into 2015. We get to the top of the yellow band here, this yellow channel. The market was at 2,135, the S&P 500, and it fell to 1,810. It was about a 15, almost 20% drop in 2015. We see it again in 2019. It starts to get over this middle channel line here, and then it gets to 3,394. Of course, it was COVID-induced. That's the whole reason we fell. But the market was getting a little frothy in 2019. And I also can't forget 2018. We get over this middle bar, this gray line. We even start to get to near the top of this channel in the yellow one in 2017. Then we also had about a 20% dip in 2018. And then most recently, we can't forget the bear market going to 2022, where the S&P 500 got up to 4,819. Then it fell over 20% down to 3,492. And then whenever we get to the bottom of this yellow line, that's whenever the market does a giant reversal, goes back up, where we say the valuation is too low for what the companies are earning. We saw that with Trump's big tariffs. The market was near the top of that yellow line in 6,147 just back in April, fell all the way down to 4,835, a 20% sell-off. Now here we are all the way back up to 6,765. I'm in agreement with you. Where we're at in terms of valuation in the stock market versus what companies are actually making in current money and how much they're bringing in, all those dollars, the market is expensive. But the problem is whenever we try to pick whenever we buy and sell in the market, we're no longer buy and hold investors. We're just buy and guess when to sell and rebuy investors, right? And that is not a good strategy. That is an awful strategy. So pulling up a little bit more data here, we come to Bloomberg and Dalbar. They created this chart for us, this bar chart. And Dalbar does this awesome job of always calculating long-term periods in the market, what the market averages versus how investors actually behave in the stock market, how they're buying and selling stocks. So from 2001 to 2020, the S&P 500 had an annualized return, what it averaged year after year, of 7.5%. The average investor from 2001 to 2020 only averaged 2.9%. Inflation averaged 2% from 2001 to 2020. The average investor did much worse than just buying and holding the S&P 500, and they barely outperformed inflation. And the way they measure the average investor is whenever there's lots of money being poured into the market, those are called inflows. Dalbar measured how much money was going into the market at certain periods, and then how much money was coming out of the market, how much people were selling, the outflows at any given period. The average investor would always sell at the wrong time and buy at the wrong time. And whenever we think of 2001 to 2020, we can think of this was during the dot-com bubble, the dot-com bear market. This was going through the 2008 GFC, 2019 going into COVID, 2018 whenever the Fed was raising interest rates. There was a lot going on. And so investors' gut feelings were wrong. They were wrong a lot. And this is what makes buy and hold so hard. It's the hold part. We can buy anytime we want, but the holding part feels so tough. And it's because whenever we can see on the horizon, we know that the stock market is expensive. It really challenges our just basic biology as humans of fight or flight. And whenever we see that there's some disaster on the horizon, we want to get away from that danger as fast as possible. And that's normal in everyday life, but the stock market is different. As investors, buy and hold investors, we have to just come to terms with that there is risk in the market, but it will always get better. We have to accept potential downsides or the downturns, not questions of if, but when. We know they're going to come. So I want to give you an example right now, Nick, also of opening up a stock chart of the S&P 500 on a weekly chart. And I want to ask you right now, let's say you are right. The market is at a peak. We are going to sell off. You sell right now. The S&P 500 is at 6,856. You sell right here. My question to you is, when will you buy? You just sold your whole portfolio. When are you going to rebuy? How far down does the market have to go? Does it have to go all the way down here to 6,400? Does it have to go to 6,600? Does it have to go to 6,000? Where's your buying level? What if you say, okay, I'll buy whenever it gets down to 6,400? What if it does fall down to 6,600, but it never gets to your 6,400? And then it starts going up, 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 up. When do you buy now? Do you rebuy where you sold? Do you rebuy if it keeps going higher to 7,000? What if it gets to 7,000, you buy, and then it falls down to 6,400? Do you now sell there? You see how tough this is? This is why guessing in the stock market is way harder than just buying and holding. And let's actually now assume that you're wrong. Let's say you sell right now at 6,800, and let's say, because we are in the earnings season right now, let's say that companies start to report their earnings, and all of a sudden they're reporting 5% gains in their revenues. And now stock evaluations look cheap. Stock evaluations look cheap compared to what they looked like right now. So what if the stock market goes from 6,800 to 7,000? Do you buy at 7,000? What if it goes up to 7,200? Do you buy now? I mean, you sold all the way down here at 6,800. What if you buy at 7,200? You say, okay, I'm back in this thing, and then it falls down here to 6,800 where you initially sold. Do you sell again? This is tough. And this is why buy and hold investors have probably the hardest investing strategy out there. It's very simple. You buy, you hold, you don't sell. It's buy and hold forever. It is just so hard because we have to fight against two emotions that really drive our behavior, which is fear and greed. And I think fear drives most of this decision. I don't think you're greedy, Nick. You're not out buying Bitcoin. You're not out buying individual stocks. You've already chose the buy and hold strategy. This is really fear. You mentioned this is your entire life savings, $80,000. I get it. This is scary stuff. This is your life on the line. But you have to just come to terms with the market will drop, and when it does, I just buy more. And if you can't do that, investing in the stock market just may not be for you. So that was it. That was Money with Jacob. Be sure to email me your questions at jacobbuildswealth@gmail.com. And be sure to like this video, share it with your friends. Be sure to subscribe. I will see you on Thursday.